Running a freight business right now means operating under intense, high-speed pressure, where every single mile drains cash from your accounts before you ever see a return. This chart breaks down the math keeping fleet owners awake. The average marginal operating cost to keep a truck moving has climbed to $2.01 per mile. That number is driven by heavy outlays, fuel taking 40%, insurance rising 12%, and wages climbing 8%. But here's the problem. You pay those costs today, but wait 30 to 60 days for a broker to pay the invoice. When every available cent of your working capital is locked inside an unpaid invoice, a single unexpected operational expense instantly creates a cash flow crisis. If regional diesel prices suddenly spike by 40 cents a gallon, your daily operating margins vanish. A fleet running multiple lanes has to absorb thousands of dollars in unbudgeted costs overnight just to keep commitments. Then factor in the reality of mandatory maintenance. A blown after-treatment system or a sudden transmission overhaul immediately drains reserve cash and threatens to pull revenue-generating trucks completely off the road. You cannot ask a traditional bank to help fix a truck by Tuesday morning. Large depository banks have strict underwriting protocols and demand extensive documentation, creating an approval process that routinely stretches out to 6 weeks. When the traditional banking system fails to respond to an immediate need, owners are forced into the alternative lending market. Choosing the wrong financial instrument here can permanently dismantle the business you built. To safely navigate the alternative lending market, you have to evaluate any capital offer against 3 strict metrics: the speed to fund, the structure of the repayment, and the total cost of the money. A standard term loan scores well on cost, but fails on flexibility. It drops a large lump sum into your account, meaning you pay continuous interest on the entire amount, even if 80% of that money just sits unused in your bank. On the opposite end is the Merchant Cash Advance, or MCA. This is the fastest product available, aggressively marketed to fleets that have poor credit or a desperate need for same-day liquidity. This matrix compares the two options directly. Look at the total cost column for the MCA. Instead of a standard APR, MCAs use a factor rate, an aggressive multiplier. A 20% fee repaid over 3 months mathematically translates into an annualized rate of 80% or higher. Worse, that repayment structure is enforced through daily or weekly bank debits. The MCA automatically extracts cash directly from your operating account, regardless of whether your trucks are running a lucrative lane or sitting idle in the yard. Securing fast cash without structural flexibility is a debt trap. It solves a problem on a Tuesday, but strangles your daily operations for the next 6 months. What an unpredictable fleet operation actually requires is elastic capital. A business line of credit provides a revolving pool of funds, typically ranging from $50,000 to $500,000, that scales directly alongside your needs. We're adding the line of credit to our matrix to show its primary mathematical advantage. You only pay interest on the exact dollar amount you actively draw. If you draw nothing, you pay nothing, completely avoiding the carrying costs of a term loan. To unlock this level of flexibility, alternative lenders establish a firm qualification floor. They require a minimum personal credit score of 600 and proof that the business has been actively operating for at least 6 months. If you meet those thresholds, a line of credit functions as a true safety net. It delivers immediate liquidity during a crisis and sits dormant without punishing your balance sheet when cash flow is stable. Securing this elastic capital requires proving your operational stability to underwriters before an emergency actually hits. That starts with submitting 3 consecutive months of clean business bank statements. Underwriters analyze those statements to verify consistent volume. They typically want to see your business clearing at least $20,000 in monthly deposits to prove you can absorb seasonal market dips. When deciding how much credit to request, ignore vanity numbers. Look at your largest historical unexpected expense, like a major engine rebuild, and add a 30% buffer. You must also assemble a flawless compliance package. Underwriters will scrutinize your DOT numbers, your motor carrier authority, your active insurance certificates, and your recent IFTA fuel tax records to ensure you are legally cleared to operate. Spending 1 hour on administrative prep today replaces a 6-week bank delay with guaranteed capital in 24 to 48 hours. Let's put this into a practical scenario. Imagine it is Tuesday morning. A massive, localized diesel spike threatens to stall your entire schedule because you don't have the cash to fill the tanks. Instead of panicking, you draw $12,000 from your established line of credit. The fuel cards are reloaded instantly, and your drivers hit the highway on schedule. Look at the trade-off. You pay a negligible interest fee for 14 days of capital usage, and in exchange, you deliver the freight, collect the broker's payout, and protect a lucrative client relationship. The true value of a line of credit is operational continuity. It takes an event that could trigger insolvency and reduces it to a minor, manageable administrative task. Finding a lender who actually understands the specific risks and cash flow cycles of the trucking industry is critical. That is exactly why BusinessLoan.Directory exists as a premier marketplace for transportation and logistics operators. This platform maps your financial profile to over 75 specialized lenders. You bypass retail banks, connecting directly with underwriters who value your fleet. The form takes 2 minutes to complete with absolutely no hard credit pull, keeping your credit score intact. Taking 2 minutes to submit an inquiry today gives you the breathing room to evaluate your options calmly, long before a blown tire or a fuel spike forces your hand. Preparation is the ultimate leverage. When you secure elastic capital now, you ensure that you dictate the terms of your own business growth, rather than surrendering your margins to the next unexpected bill.